Welcome back, everyone. This is Chapter 6, and I'm doing this video basically to cover some of the material out of Chapter 6 and identify some important things that you'll need to be aware of. To start with, this chapter covers internal control, fraud, and cash. So to start with, I want to talk about internal controls, and internal controls are important, particularly with cash, because that is probably one of the more difficult assets to track. You cannot really track cash. You can count it, you can identify how much you have, but nobody writes down all the serial numbers from the bills to keep track of them. So internal control systems are designed to protect the business and to protect those assets from potential fraud from employees or other people. And it also ensures that you have reliable accounting records, promotes efficient operations, and basically makes sure that your policies are being followed. Internal control has always been an issue in accounting and always been an issue in auditing, but it became a really focus of attention after the Enron collapse in 2001. Sarbanes-Oxley was the law that was written following that collapse. And basically it addressed some of the shortcomings that were noticed in both Arthur Andersen, the CPA firm, that, by the way, collapsed as well, and in Enron, things that were not done that needed to be done. So basically Sarbanes-Oxley requires any CPA firm auditing a publicly traded company to evaluate internal controls to make sure that they have effective internal controls. The auditors evaluate those controls, and then they have a finding that they put in the form of a letter that addresses internal control weaknesses, if there are any. And basically, that document goes in with the audited financial statements and the audit opinion letter at the end of the audit. And by the way, the Public Company Accounting Oversight Board, PCAOB, is the people that oversee all of the accounting work on the auditor's work on these things. The COSO framework is basically a way of thinking about internal control that breaks it down into components where you can actually look at what are the risks here and how do we deal with those. So you have a control environment, which is the company structure, the ethics, the integrity for internal control. Many times this is the environment that management operates in. You're going to have risk management that you're going to look at, or risk assessment. That's another piece of the framework. You're going to identify what are the potential risks and where are those risks more prevalent. Control activities are going to be the policies and procedures you write and put in place to reduce any risk of having loss. Information and communication really is going to be how you report information internally and externally. And that means you're communicating policies, you're communicating with each other in the business. And then finally, the monitoring, which is a regular review of internal control effectiveness. Even if there's a CPA firm auditing you for internal control effectiveness, as a business, you should probably do this on a regular basis. And many businesses use internal auditing as a way of doing that. So the principles of internal control are basically going to identify where responsibilities for certain functions are. They're going to maintain adequate records, and you're going to ensure assets, and you're going to bond key employees. And the bonding of employees is in the event that there is a loss, or basically that employee engages in fraud, the business is insured against that. You divide independent parts of an operation so that you do not have the same person doing two pieces of one related transaction. So what they're talking about here, dividing responsibility, means that you're basically going to split apart the person that records cash receipts from the person that deposits them. You're not going to have the same person do both activities. And then you're going to apply technological controls and then perform independent reviews. So we've already talked about how you can identify the responsibilities. Individuals will have responsibilities for different parts of the function of the task, and it'll be identifiable. You're going to keep adequate records. For example, if you're bonding employees, you're going to keep records of the bonds on file. You're going to have assets insured. You're going to also have detailed records for the accounting department, for the accounting records in the books and that sort of thing, where you track account numbers, and you have a systematic arrangement for that. You want to separate record keeping from the custody of assets. In other words, you don't want the same person holding on to the asset that's making the record, because it would be too easy for that person to make an asset disappear or to use it for some other purpose. Applying technological controls, basically this is going to be using things like a cash register, a time clock that scans a badge, personal identification scanners, that kind of thing, where you actually are signing in, the employee is, before they do any of these activities. There's also the need to do some regular internal reviews, and that would be typically through an internal audit department. So using technology, you want to make sure that you use technology, but you want to make sure that internal control is applied to the processes as well. So they're always going to be relevant no matter how technological you are in the business. You want to take a technologically advanced system to reduce processing errors, basically to allow you to test more records more often, so you're able to verify the information that's in those records. And technology also makes it possible to record additional details about a transaction that you wouldn't normally have if you were doing it manually. And then separation of duties, that would be another item where you would have two people doing two different things. So the computer operator would not control check writing activities, as an example. E-commerce is increasing and has been for some time, so places like Amazon and eBay are successful e-commerce companies, but those transactions involve some kind of risk. For example, credit card theft, that's a possibility. Computer viruses are another possibility, and impersonation, which basically is somebody with stolen credentials getting in and basically processing some transactions. Now, the limitations of internal control, they can be thwarted by two or more employees if these three things are present. If you have an opportunity to basically violate internal control, if there's a weakness, if you have pressure from some source internally, basically to succeed, or if you've employees are justifying the fraudulent behavior, if you have some rationalization occurring. This is what happened with another company that's not often mentioned, or maybe it is, HealthSouth, who basically had a lot of pressure on to meet certain sales goals every quarter in order to meet Wall Street's expectations. So they had all this pressure on, and some of the employees basically got together, and in order to avoid the pressure, they used an opportunity, a weakness in the system. And by the way, the CEO of the company was involved in this. They all rationalized it away, but they basically created false transactions which were below the auditor's threshold for examination, and which would, by the way, allow them to report higher income numbers. That kept Wall Street's expectations up, but it also was a fraud. And it basically wound up causing a great deal of problems with the company. Although the company didn't collapse, the CEO obviously is no longer there. So there are a lot of questions that you would probably need to ask, including how people will potentially violate data, how they can get in and breach your data that you're keeping. What are the risks, and how do we actually avoid those? So one of the things that they report here is that 43% of frauds are detected from a tip, which is a very interesting insight. It means that fraud goes on, but many times they basically have to tip you off to let you know that it's happening. Okay, we've talked about internal controls and fraud, but basically we want to talk about cash, because internal controls are really important for cash, because cash is an extremely liquid asset. It's not traceable unless you keep record of all the serial numbers, and nobody does that. So you want to make sure that cash is handled separate. Whoever's handling the cash is not doing the recording of cash. And however cash receipts are received, that they're put in the bank immediately. Disbursements are made by check or electronic funds transfer. You're not actually paying anything out in cash. So when we talk about cash, we need to talk about cash and cash equivalents. Cash obviously is the cash, the actual dollar bills, the change, the coins that you have. But cash is also considered checks that you have, cashier's checks, and things like that. Cash equivalents are short-term and very highly liquid investment accounts that you have, and you have to be able to meet two criteria to be cash equivalent, and that is you can easily convert it to cash, and it has to be a known amount of cash, and that it's close enough to the due date that their market value is not going to greatly change. So if you've invested some money in a CD that's very short term, that's a cash equivalent. One of the things that we're going to talk about is cash management, and we're going to basically create a cash budget that will plan cash receipts to meet the cash payments when we need to. We want to encourage collection of receivables and delay payment of liabilities, and we're only going to keep what necessary assets we have to have. And we're going to plan out the expenditures we have so that we don't have a shortfall in our cash. One of the things that we need to do when we talk about controlling cash is to make sure that when we receive cash, like if we're in a retail business, a merchandising business, customers are paying cash or checks to us, that we make a daily deposit in the bank, at least a minimum of a daily deposit. If we're a larger business, we may want to make more than one deposit at the bank. We do not want to keep too much cash on hand. The problem is that if we do, that the likelihood of there being a robbery or a loss of an asset is increased. So basically we're going to take the information we have from the people that are collecting and handling cash, and we're going to pass it along to the accounting department, and they're going to record the cash, or somebody's going to record the cash. Now, when you do a cash register, you're going to count the drawer at the end of the day, and you're going to look at that and compare it with the receipts that you've had from that day in sales, and you're going to know that you should have a certain amount of cash in the drawer compared to what the receipt says. Well, if the receipt says you should have more than what you have in the cash drawer, you have an issue where you're short on cash. And if, on the other hand, your cash count in the drawer is higher than what the receipt says, then you have a cash overage. So here you see the journal entry necessary to record the cash overage. So we counted the cash drawer, and we have $555 that we have in cash. And the sales receipt that we have says $550, but we have $5 more than what the sales receipt says. So we have an overage of cash. We credit cash over and short. On the other hand, if we're short cash, we're going to have a cash account that's different or smaller than the sales receipt. And the difference there is going to be related to being short. So we want to debit cash over and short. This will go both ways. It may be over one day, short the next. Typically, there's a threshold that you do not want to exceed. We'll receive cash by mail, but not typically cash. We'll receive checks more often. We do not want to have cash sent by mail, but we will often see checks coming in the mail, and we want to make sure that we're keeping track of that and depositing it on a regular basis. We want to control cash disbursements as well. So by setting up the cash budget that I mentioned earlier, we will be controlling those amounts. We'll be identifying when those should be paid and how they should be paid. We also want a voucher system basically to control it. And a voucher system basically is a series of steps that requires a level of approval for purchases in a business. So you will have a voucher, which is an internal document, basically, and that has to be approved before you can actually get into a cash disbursement situation. So typically you're going to go through a series of documents leading up to the voucher, but in this illustration here, you have a series of requests that are made, and you see the different departments that are handling that, and this voucher system is going to handle all of that. So you'll have a request for purchasing requisition, which is a request. You'll have an approval for that, which is a purchase order. You'll receive it. You'll get an invoice. You'll receive it. You'll have a receiving report, and then you'll get the invoice approved and write the check. So that's basically the voucher system. As we get into more about cash, one of the things that we need to think about is petty cash funds. Typically, an office or business will keep a petty cash fund if there are very small expenditures that will occur that they don't want to write checks for, or that may occur on a daily basis or frequently in the office. So if you are in a business like I have been before, and the person who is the mail carrier comes in and tells you you have postage due, you want to pay that mail clerk right away in order to avoid any problems. So you basically would take this out of the petty cash drawer, write out a petty cash receipt for it, and have the person sign it that they received it. So then basically you have documented what that was used for. In this case, they're paying freight charges for, it looks like, $15.05. So as you go through the petty cash, the month of the petty cash, you're going to have an accumulation of those receipts, and you're going to record those at the end of the month. So you're going to gather those receipts together, and you're going to say, okay, what do we have in petty cash? We have $71.30 in receipts. Our petty cash fund began with a $75 balance. That means that if we've used $71.30, we should only have $3.70 in cash remaining. So we go through this and we add those up, and we do have $71.30. But to do the journal entry, we're going to debit each of these receipt items to the proper expense or asset, depending on what it is. So the merchandising miscellaneous expenses that we debit here, and then we have merchandise inventory here. With merchandise inventory, we're basically paying for the freight charges, and then delivery expense, and then office supplies expense. We purchased something or paid for something for office supplies. The cash will be credited because we're taking $71.30 out of the cash account and putting it back in the petty cash drawer. So you can increase a petty cash fund. The journal entry to start a petty cash fund, by the way, will be simply a debit to petty cash like this and a credit to cash. Once you do that, you're never going to make any more entries to petty cash unless you change the size of the fund. And that's what they're going to do here. They're going to increase the size of the fund by $25. So they basically add $25 to petty cash. They take $25 out of cash. On the other hand, if you decreased it, you would debit cash and credit petty cash. But whatever the amount that you set it at, you can increase it or decrease it. But typically, once you set it, you're not going to do entries to petty cash. It is possible after you go through the month's receipts and petty cash, you'll be over or short cash in the drawer. And so you want to have some classification for that here. So, for example, as you go through these transactions, if you had, we had this example in class, but if you had transaction where you had 170, in this case, $178 in miscellaneous expense, but you show only $15 in cash remaining, that means there's a $7 difference that's unaccounted for, because 178 from 200, which is the fund balance, is 22. But you've only accounted for 100, and you say that you should have $15 in cash remaining. That there's should be $185 that you need to replenish. So somewhere there's a missing receipt. So in this case, you're going to identify that $7 as cash short and over to basically account for the difference. When you're talking about other issues with cash, you're going to talk about banking services. Typically, you're going to be involved with a bank writing checks for the business, at least have a checking account that you can utilize for the business. And a bank will do many things for you. So first of all, this is a deposit ticket that you take to the bank with your cash and your checks or whatever. Typically, you list out checks, but you count cash and you just put the lump sum amount here. And sometimes the bank will collect money for you. So if you have an accounts receivable or a notes receivable, the bank may collect that for you, but they'll charge a fee. So you can have the bank do that for you, and it'll ease the process for you. With a bank statement, we're going to have a listing of all the deposits and all the checks that we've written and any fees or charges that are taken out. So when we go through the bank reconciliation, what we're actually doing is we're saying the bank says we should have this amount of money, and we're saying we have this amount of money, and the two are not the same, so we're accounting for the differences. And when we account for the differences, we identify things that are outstanding that the bank hasn't taken into account. And from our checking account or our book balance, we account for things the bank has recorded, but we have not recorded in our books. So when we adjust our book balance, we're only adjusting for things the bank recorded that we didn't. And when we look at the bank balance, we are looking at adjusting it for things that we have recorded, but the bank hasn't yet. We never adjust the bank balance. We do adjust the bank balance amount for the things that it hasn't recorded. So, for example, with this, we begin with the bank balance, and if we have additional checks that are that were deposited but didn't make it on the statement, we want to add those in because they were deposited before the end of the month, but they didn't make the cutoff time, so they didn't get it on the right day. We'll also subtract any outstanding checks that are that the bank hasn't received yet. So we have some outstanding checks we need to take into account. And then we'll account for any timing differences or errors that the bank may have. And the bank will possibly make errors. And then on the book balance, what we're going to see is a timing difference as well. And so we'll deduct out of the book balance possibly some fees, bank fees, and so on. If the bank collects for us cash that is on a notes receivable, we'll add that in. If we've made a mistake in the amount that we recorded a check for example, if we put it in at 93 but it should have been 39, there will be quite a big difference. We'll need to make an adjustment for that, and we'll show that here. The purpose of the bank reconciliation is really basically to identify those items that require adjustment, to make sure that you are keeping the balances in check and that you're keeping a close control over your cash balances. So they define outstanding checks, deposit in transit, outstanding deposit, these kind of things here. These definitions are important. You'll want to know what they are. Again, on our test, you'll have some multiple choice questions, so terms will be important. This is a great example of a bank statement reconciliation. We worked through something like this in class. Be prepared to do something like that as well. Then when we actually do the reconciliation, there will be some adjusting entries we'll need to do. So, for example, if we collect a note, if the bank collects a note we didn't know about, we'll basically record the cash and take the fee, whatever the fee is the bank charges us, out of the cash we receive, and we're going to call that collection expense. But we will credit our customer for the entire balance. We'll have interest earned, interest revenue on different things. We may have an order for checks. That'll be a miscellaneous expense. And if a customer's check does not clear when it comes back, when it goes to the bank, we'll need to reverse the payment that they originally made, which we would assume goes to accounts receivable. And so what we're going to do is we're going to debit accounts receivable to show that balance is unpaid again, and take that cash out of our account in our accounting records. Okay. Basically, that really deals with most of the things that are in Chapter 6.